if you can borrow money and you have a big idea, now's the time to strike, because you're going to get the tailwinds coming out of this recession with all the stimulus.
Some of the biggest winners are those that have the ability to check their emotion at the door and become countercyclical, says today's Ask an Expert. Hi, I'm Joshua Carlson, co-founder of Propelo Media, and today I get to sit down with David Waddell. David is the CEO of Waddell Associates. It's one of the biggest private financial institutions in the country with over 900 clients. Today, he's going to talk about the difference between asset management and wealth management and why you should be focused on the latter. He's also going to time travel with us, take us back to March 20th, what he saw in the market in that moment, what he forecasted, and what he's seeing today as we look ahead into the future. And finally, we're going to talk about the balance sheet. While it's important to be focused on the P&L for your day-to-day operations, it's the balance sheet that has the powerful impact to amplify your business and help it scale quickly. Now let's hear what David has to say. David, welcome to our Ask an Expert.
Thank you for having me.
All right, so coming out of the gates, I'd love for you to just do a little bit of differentiation for our audience, the difference between asset management and wealth management.
Good question. A balance sheet has two sides. It has assets and it has liabilities. Traditionally, money managers only really look at the asset side of the balance sheet. So if you've got $1 million and you want to have $2 million, you'll hire an asset manager and you'll hope that they can perform and you'll pay them a fee to do that. My vision of what we do as wealth managers and wealth strategists, even a degree further, is that we look at the asset side, but we also look at the balance sheet in totality. So we're looking at the liabilities as well. We're really in the net worth business. So whatever I have to do to make your net worth bigger, that's what I want to do. And if that's help you expand your network, or if that's consult on your business, or if that's negotiate on your behalf to get better loan rates, then I'm going to do all that stuff. So a traditional asset manager just takes a pot of money and runs it for a fee, and hopefully it grows. Wealth strategist runs a really more comprehensive model, think more of a McKinsey consulting model, except also managing assets and doing whatever it can to assist with liability structure. So I'm in the net worth business, not the asset management business.
Okay, and I like this approach because not only are you working with the assets that you have at your disposal, but you're focused on actually generating the business to produce more assets. So let's talk about some of the common ways that you might help a business look at their portfolio, look at their actual business model, and say, hey, we recommend these 2 or 3 things that can actually get you moving in a faster direction.
So I'll tell you a real-time story if I can. I won't use names to protect the innocent. But I had a conversation the other day with somebody in a standard business, and very business or very busy professional, very good at the business, well-regarded business, but not spending enough time policing the P&L, okay? So I had a valuation done on the business, and the valuation came in a little bit lower maybe than that entrepreneur expected. The reason it came in lower is not because revenues weren't high, but because the profit relative to the peers wasn't high enough. And so the conversation became, okay, we do need this illiquid asset to liquidate at some point so that you can go retire and be happy and have enough capital to be able to do what you want to do to maintain your lifestyle. To get there, we got to get the valuation on this business up. So we got to go from, I'm going to use fake numbers, we got to go from a 5% profit margin to a 15% profit margin. How are we going to do that? Well, we got to hire the right kind of person, right, that would boost that profit margin so you can get that valuation so you can go sit on the ranch and smoke a cigar. Sure. So that's a much different conversation than, well, if we get 15% returns out of your portfolio rather than 8%, we'll get there. So that's an example of how we might have a conversation that's strategic in nature with the business owner that is very distant from a traditional conversation with an asset manager. Sure. And then we go to work on where do we find that person? And we're not in the search business, but you light up networks and you do whatever you can, because we've got 950 clients, lots of them business owners in 40 states. And so there's just a lot of reach there.
Okay. And I like that approach because I feel like when it looks at the P&L, a lot of it is focused on the expense side of things. Like, hey, how can we trim this? How can we trim that? But I like that approach because you're actually looking at like, how do we actually grow? How do we take this revenue and actually squeeze more out of it? And I assume a lot of that is pricing.
I think this is a really interesting moment in time, because pricing right now coming out of recession gives you a lot of opportunity. You needed to sort of raise prices going into the recession, and that's what we advised our business owners to do. Now that we saw the pandemic coming, but we've been in a 10-year, economic advance. And so at that point, you're kind of like, all right, let's husband some resources.
Sure.
And so you've got some pricing ability, elasticity. So you could raise your prices going in. Now, if you've got balance sheet strength, right, because you listen to your wealth strategist, you can cut prices right now and gather even more market share, right, and really wound, not that any of us want others to suffer, but you can wound the competitors a little bit right now too.
Sure.
So I think pricing is something people really don't spend enough time on. And as entrepreneurs, I know because I do this myself, you actually can charge more than you think. Right.
Yeah.
All of us in our core are insecure and control freaks, which is why we're in the positions that we're in. But the reality is, people aren't as, I think, disassociated with your business by pricing changes as you think.
Right.
So anyway, I do think pricing somewhat interesting. That one wasn't specifically a pricing conversation, but we've had those too. And I'll tell you a quick anecdote. One time, I was at an EO conference or an industry conference, and we were in Vegas, and I was in the Wynn Casino, and I had this opportunity to sort of talk to Steve Wynn, and I was contemplating my pricing strategy, and I'll spare you the expletive. And he said, let me just tell you one thing. Don't you ever beeping cut your prices. It's kind of interesting. So pricing is a big lever that entrepreneurs don't think about enough. So I think that was a good question.
Well, and I'm glad you touched on it because I do think, the insecurities that you mentioned, they definitely reside in almost every single one of us, aside from maybe Steve Wynn. But I think that it's important to understand, especially on the service side, if you do have a service-based business, even if you're selling products, depending on how you service those products, you do have a tremendous opportunity to look at your pricing structure. And chances are you can raise those higher than you want. I've talked to about 4 or 5 businesses in the past month. Every single one of them has raised prices and they've not lost a single customer.
Right. But that entrepreneur flipped over, 50 times that night before they rolled out that price increase and thought this is the end of the business. Everybody's going to fire me,
Right.
It's not usually the case. People don't really, disassociate, like I said, that easily.
Correct. Okay. Well, I want to go back in time. You've had your firm for quite a while. I'd like to actually go back to the beginning of that. How did that come about, and tell us the story?
Well, it's a family story. My father made a bunch of money, a bunch, not a ton, but enough, and put it in a bag, as he said. We went to South Florida, and he was like, who am I going to give this money to? And he was a pretty savvy guy. He didn't trust the bankers, the brokers, the candlestick makers in South Florida at the time, which was a good call. And so my mother said, just do it yourself. And at that time, you had the ticker tape show up on TV. You had discount brokerage platforms like Charles Schwab, which nobody had heard of, where you could actually transact at a low cost. And so he started doing it himself. And this business at its core is really about trust. That's what it's about. And so he had a couple of his buddies call him up and said, look, I know you're sitting in South Florida managing your own money. Would you manage mine? And he said, I don't know. Sure, maybe. And out of that, a business was born. But for him, it was a hobby. Okay. And so it was, I'll manage money for family and friends, we'll charge a fee, but I'm never going to call them and ask them what they want to do. I'm just going to take a discretionary role and their portfolio will look like mine. And that was kind of it. I ended up in a circuitous route, ending up in San Francisco, working for Schwab in their strategy group. And one of the things we were tasked to do was go around the country and figure out where financial advice was going to go. Okay. And at that time, and this was the late 90s, it was all about the asset manager role that you talked about earlier, which I think is just a piece of the puzzle.
Yeah.
And what I saw was that people cared about returns, but you know what their number one irritant was? Actually, it was taxes. People hate taxes, right?
True.
I mean, the altruistic in us may say, I'd be much more willing to pay taxes, but I've never seen anybody actually gross up and pay more tax. So tax management is like what people really stress about. So I was like, well, I mean, if I went and did a business like this, I would add on CPAs and give the clients the confidence. And if we're going to do that, then maybe have some attorneys talk about estate work, et cetera. So what if I brought really a comprehensive personal financial strategy consulting practice to what had traditionally been an asset management client? So that was the idea, the big idea, if you will. So I came back to what was a really, not a small business, but a pretty small business in 2000, and sort of deployed that strategy and, won the hearts and minds of the existing clients who went from being partial clients to full clients. And then, obviously we expanded a great deal and word spread. And we continue to our core to be the most trustworthy. So the big idea, though, was probably, incubated during that stint in the strategy department of Schwab, which was to provide that comprehensive service that we started this podcast talking about. So that was the big idea. And then hiring people that had a lot of degrees. Traditionally in my space, the people that talk to clients are salespeople, period, right? I wanted to sort of move the salespeople to the back and push the real technicians forward. I wanted to push the CPAs forward. I wanted to push the CFPs, the certified financial planners, forward. Now, we could grow a lot faster if I just had the salespeople up front. So it's been a great growth story, but it could have been a turbocharged growth story if we were willing to do things differently or cut corners. But quality matters to me more than quantity. And so we've maintained our sort of integrity through that process. But trying to get my technicians to sell is a challenge.
Understandable. Well, I'm glad you brought that up, because you preemptively kind of answered my my next question, which was, when you were looking to hire and you were looking to actually build a business, were you looking for junior people that you could build up, or were you looking for seasoned people that already had their chops? They came at a higher price tag, but they were able to hit the ground running incredibly fast.
I really like a apprentice, journeyman, master transition plan, right? The masters come in and some of them are worth paying for, but they've got all these embedded tendencies and they've got their own sort of cultural nuances, et cetera. And sometimes you can transport those people, at the later stages of their career in, and that can be successful. But the people we've been most successful with, and there are a lot of baby Waddell Associates out there, that sort of learned the craft and then spun out and did their own thing. Sure. And I know I'm supposed to find that gratifying, but it's just like, if I could have kept them. So we have a lot of graduates. We have a lot of alumni. But I really like that idea of sort of getting those that are hungry, that are versed, that demonstrate dedication to the craft, and then getting them into an incubation phase, if you will, that apprenticeship phase, starting to give them clients in a journeyman phase where they can really learn the craft and ultimately be masters, working with the new apprentices. So that's my fantasy on the way it works. And it takes a long time. Right. And quite honestly, with one of my newer people, it takes a while to break even on them, right? It's a big investment on the business side to get them to where they are cash flow positive. But if they're high quality, then they're going to be great people within the business, great with the clients. And so that's an investment I'm willing to make. But it's different than other firms that would just pay them on a percentage of revenue. You have no fixed cost. It's all marginal cost. So it's a very cost intensive model to do what I'm doing.
Okay. But it's building a better platform at the base.
Yeah. And ultimately I want the clients to be successful, right? And so for the clients to be successful, we've got to have ninjas working with them who are really dedicated to them with bedside manner. And those are nuanced, you got to be head and heart. You got to be quantitative and qualitative.
Right.
That's a special person. It takes a little while to develop those people.
Okay, well, let's talk about when you were taking over this. It's not completely small, but it's smallish business. What was the marketing strategy for you to look, now that you have this new business model, to go out and actually start capturing some of that market share?
Yeah, I had no idea. I was just sort of making it up as I went. And so I had the ability, thanks to, a liberal arts education, maybe, to carry on a competent conversation. and I had credibility in the marketplace because people had recognized I'd done some things of note in the past. And I just went out in the community as much as I could and sort of told the story. You know, every entrepreneur, I'm kind of a reluctant salesman, but every entrepreneur is a salesman. And so I just spent a lot of time asserting, this is our model, this is what we do. And the business kind of came to us. I mean, I asked for business some, and you have to do that.
Mm-hmm.
But I also differentiated us enough from sort of an incumbent strategy
Right.
that people were attracted to it. Now it's harder. Thankfully, we have scale now, but you know, now if you watch TV, every advertisement for somebody who does what I do looks the same.
Right.
You know, so we've sort of lost the freshness to a certain extent.
Sure.
Now I have some plans and some strategies maybe to revive it. And we've got a great reputation, so scale begets scale. But it's a hard marketplace. I mean, we're in a really crowded marketplace. And so to differentiate yourself, you got to do stuff like this. Thank you for having me on.
Of course.
And you got to be in the conversation. And so I think that's how, you know, that attracted people to us. And then you have to prove it. And the quality of our staff really proves it. But, you know, I don't know that I had a beautiful marketing strategy because I didn't have a beautiful marketing firm to start off. I don't know where you were. Could have used you. So it was a little bit of trial and error, but it was, you know, you just got to get noticed and then deliver on your promises. And that was sort of the magic of the business model.
And how much of your business today do you think is actually coming from existing clients that are happy with what you're doing?
Well, they define that in our industry as wallet share. So if you have $10 million, let's say, and I hope you do, but if you have $10 million and you put $1 million with us, then we've got 10% of your wallet share, and that's liquid money. The way we run our model, we really have almost 100% wallet share. So our existing clients, and it's a great compliment, are kind of all in with us currently. And so the growth comes from them being successful. Yep. So if I could be useful, help you grow that business, and then you monetize it, that's a source of new money. And then if they say something nice about us to their friends, because we're not a sales machine, we're sort of a referral machine, then that's how we grow as well. So most of the business comes from our clients being successful, but not from wallet share and from introductions to other people that are like them. And it really becomes a community. I've often thought about it as membership has its privileges, and I want to be able to do things inter-client, where if you were selling a house on a beach somewhere, I could post it on a site and, you know, everybody would know that you were qualified because you met the minimums and you were a client.
Sure.
And all these privacy things got in the way, and I could never really do that. But the best thing about our business is who we get to spend our time with. It's a great group of folks. And that affinity, I think, grows the clubhouse also, if you will.
Okay. Well, I'm glad to hear you say that. I mean, one of the biggest themes that we've been hearing as we've been doing the show is customer experience right now. And yours is a little bit more transparent than a lot of the businesses because we're dealing with wealth, right? And so, you know, you talk about P&Ls, talk about assets, you see hard numbers. And so it's really easy to translate. But because of that, you're able to actually grow that wallet share that you're talking about by focusing on the customer experience.
Yeah, and guess what? My job is to predict the future. Like, that's a really hard job. So the markets are always going to bounce around. They're going to create anxiety. So to me, to make those relationships sticky over time, since I can't really tell you exactly, I'm pretty good at forecasting. I can't tell you what the market's going to do 5 days from now. Pretty good at like 50 years from now. But 5 days from now, it's tough. So you're selling something ultimately. If what you're selling is returns, you're screwed in this business, right? And I'm proud of our returns and we're good at it. So you got to figure out a way to be more relevant. Like, I can trust you enough that if something happens to me, you can take care of the wife, the kids, the husband, whatever. You're embedded enough in my world that you found an error on my tax return that I wouldn't have found otherwise. So there's got to be utility that extends beyond that sort of initial transaction, which is I'm buying returns from you. And I think if you get stuck in that, and a lot of people do, then your business can get real big and real small, real fast. So the built to last aspect of our business is really figuring out how to become deeper in the relationships that we're in, right? In a meaningful way, not a parasitic way, right?
Right.
So that relationship dynamics and management is a super important frontier of this business. And I think people are trying to figure that out, especially in this digital age. I think we're really good at financial planning. I think we're really good at investment management. I want to be better at relationship management. So that's sort of my field of study right now, to figure out what that looks like 10 years from now. And that's a big question.
Okay, well, let's talk about the market. And let's talk about the market from where you've seen it, let's say March to where it is now, and what kind of roller coaster you've seen.
So I did, the quarter ended on March 30th, always does, right? First quarter. And I did a presentation to the client base and then our network on March 20th, right? Okay. And people were totally freaked out at that moment in time. And I went back and watched it the other day, and it was a great moment because all my intellectual pistons were firing, trying to figure this thing out, comfort the clients, figure out where it's going to go. The government hadn't really acted yet. I mean, there was a lot. If you can go back into that crucible in your brain of what March 20th was really like, it was nuts. Acme was on TV saying hell is coming. I mean, it was nuts. I was excited.
Okay.
Because I looked at it all and I said, we're getting ready to get a boatload of stimulus. And I went back and did all the historical comparisons. And, we have had 4 big pandemics in the past. Those that you don't remember, like 1969, that killed population adjusted 250,000 Americans. And we got through them. The economy came out the other side fine. The markets came out the other side fine. So history would tell you that we manage our way through pandemics. In fact, I was encouraged to read in your neighborhood that the redwoods survived the wildfire that went through them the other day. Yeah. And in fact, upon closer inspection, redwoods have fire scars all over them because they always survive. So that's kind of like the pursuit of prosperity for the human species will survive. So I knew that was going to happen. And then we were getting ready to get all this stimulus on top of that. So the natural animal spirits would lead us back because that's who we are and what we do as U.S. consumers. Add to that, $3 trillion in stimulus from Congress and $7 trillion in stimulus from the Federal Reserve. We had a $2 trillion problem that coronavirus made, and we solved it with $10 trillion in stimulus, and there's more coming. So what I saw was, holy cow, this market's going to rip coming out of this. And if we get a vaccine, it's going to rip even more. So I was actually pretty bullish and stated on that day that the market would bottom in the first quarter, the economy would bottom in the second quarter. And I really only had 7 days because it was the 20th, and there were a couple of days in there for weekends. And so it was sort of a crazy prediction, but it ended up turning out that way. And I don't think it's over. I really don't. So the amount of stimulus in the system and the more that's coming, paired with our natural animal spirits, which lead us out of recessions traditionally, just is going to end up being a combustible economic situation, which is fantastic. We just have to figure out how to get there. Right. And so the entrepreneurs that are involved in that or pivoting, or the large businesses are prospering today, we just got to get 9 months into the future and everybody's going to feel great again.
Right.
And 9 months into the future, the market will be higher, the vaccine will be in place, the election will be resolved one way or the other.
Yeah.
So I could see that all once that panic reached such a big crescendo, because the bigger the panic is, the bigger the knee-jerk reaction from the government. And they spent a lot of money to buy us this bull market.
Right. Well, so let's talk about one of the things that I'm hearing chirping, which is basically the end of rent and mortgage deferments. Where do you see that going, and what kind of impact do you see from the overall economy?
Well, Trump in his executive order extended some of that, and I assume that'll get revisited in the stimulus that'll at some point show up. I hope they come back from vacation September 7th. So I hope they go back to work. But rents and all those things end up being micro negotiations anyway. So you talk to your landlord and you figure out what can be done. And in terms of regulatory deferral, I think that continues, because if you're a government official right now and you mandate that, they said today, I was listening to it, New Jersey's going to allow people to go back into their gyms,
Okay.
but only at 25%. And you have to keep your mask on, social distance, and you have to write down all your contact information so that all your friends can be called if you get COVID, et cetera. Like, congratulations, you can open, gym owner.
Right.
Right. So if they're going to regulate you out of business, they sort of need to give you something in return.
Sure.
Right. And in these previous pandemics, 69, 57, 1918, we didn't regulate people out of business. That's new.
Right.
And so if you're going to close something down, you better compensate them for it. That's the way our system works. So I imagine there'll continue to be some relief there from a regulatory perspective, and that's at a macro level. At a micro level, it's just a phone call. Look, I'm not paying you this month. You can evict me. You can tack it on to the end of the lease, but I don't have the wherewithal. And then see where those conversations go. So I think forbearance is something that's maybe at macro level a government responsibility, and then at micro level, the tenant responsibility.
Okay. Well, I think we're all going to hitch our wagon to your forecast because I think it's a good one, and I think it's pretty accurate. I'd like to just talk about investing in general. When it comes to investing, do you think that you can train that? Do you think there's a recipe that you can provide somebody, or is investing more of it's kind of an innate part of someone's DNA that they have it or they don't have it?
I think it's really a question of risk and control.
Okay.
I think there's a misnomer that entrepreneurs, for instance, are fearless. It's the opposite. They're terrified, right? And so we need control because we want to try and, create the outcome we desire, right? So I think entrepreneurs specifically and business owners have a lot of their net worth tied up in their business. They have a lot of net worth tied up in their home. By the way, those don't price every day. So you have no idea what the price of your business is today.
Right.
I can probably figure mine out, but most people have no clue, right? So your biggest asset prices every day, but you don't see it. Then you got your house, which may be your second biggest asset, and that prices every day, but you don't see it. The pricing on TV of the stock market makes people crazy. Now, some can say, well, that's just, I understand it. It's a long sort of road and I'm not worried about it, but most can't. And the more the media sucks us in, the shorter the hold period gets for securities. So investing is a big psychological discussion, right? It's not really a financial discussion because it's going to work out. Right? There's never been a period of 20 years in the US stock market history where it actually had a negative annualized return. So if you were just sort of, Rumpelstiltskin and you could just go to sleep and wake up 70 years, you'd be rich. But people don't operate that way. So it's the timing mistakes that people make that twist them up a little bit because it's a long-term process, but we've got a short-term attention span. So that's where the conflict is. So you got to have some courage. I think at this point in what we do, the markets are no longer rewarding sort of the guru stock picker, the Warren Buffett that would pick a couple of stocks and he'd call management and he'd have the inside straight. And then the rest of the market would wise up and those stocks would go up. That game's kind of over. So much is being automated. The money flows are indexed or quantitative or ETF, et cetera. So the question is, how do you manage risk? Because it's no longer you pick a stock that's got a rock solid balance sheet. That doesn't work anymore. The way you manage risk and the way I'm seeing the markets is how much overall exposure do we want to have? Okay. So last year, for instance, we looked at the market in totality as we were tightening with the trade tensions. The Fed was too tight. And we said, this thing's going into recession, right? That's the path we were on, basically. Right. And so we put a hedge on the portfolio. We took down our overall risk exposure from, call it 100% to 80%. And then the Fed came through and said, we'll pump some money. We said, all right, we'll take 90% risk exposure. And then we held on to that. COVID hit. That short position was super helpful. And at the bottom, in March 20th, we were saying, now we want to take on more risk. So
Right.
I think dialing up and dialing down risk at the margin is really the only decision that people have to make anymore. You don't need to make the decision, am I in the market or out of the market? Because those binary decisions will kill your returns over time.
Right.
They always have. I don't know anybody who's built a 60-year career in this business going full in, full out. I just don't.
Right.
And the hedge fund returns over time tell you there are very few people that can do that. So to me, it's what's the asset allocation? How much do I need from equities, right? Because 10% is sort of the long-term rate of return there. How much do I need, in bonds? That's 5% over a long-term rate of return. And however that configures into your financial plan should be the guide star. And then you sort of dial up or dial out risk when there's opportunity, right?
Right.
You're 10 years into an advance, then maybe you take leverage down a little bit. Maybe you dial down risk a little bit. If Apple's trading at $3 trillion, then maybe you take a little off the table. So I think it's a tweaking around the edges, but people are full in, full out. I think that's where people get hurt. The returns for the average investor are about a third of the index returns over time because they make bad decisions. So you need a financial advisor. That's the point there.
Nice subtle plug there, David.
Yeah.
Well, so I like that approach because, I like how you say it's not as much financial as it is about emotion, right? And it's just trying to take that emotion out of it and just, and I appreciate the P&L aspect that you take because, I've been in businesses where we look at the P&L monthly. Everybody on the management team is looking at it so that they understand the hard facts of the business as opposed to hearing the squeaky wheel. It could be on the production floor from employees, or it could be the squeaky wheel from the customer, and suddenly we're making radical changes that really have nothing to do with the core staple of the business.
Yeah, and I think when you look at how people get really rich, it's they understand the balance sheet too. Like, when do I lever this business up? How much debt should I take in? Should I bring in another partner? How do I maximize my equity? What does that really look like? That's where you get the fuel, the amplification. For instance, a lot of people love real estate. They love real estate. They think it makes them big returns. They don't really invest in real estate. They use leverage, right? So if you're going to buy $1 million building and you put $200,000 down, you're borrowing $800,000.
Yeah.
You're levering up $200,000, right? And so let's say that business goes to $2 million. Well, you pay the $800,000 back. Now you got $1.2 million. You feel like you crushed it on the real estate. No, you crushed it on the use of leverage.
Yeah.
Right. So I think one of the things, and my father's no longer with me, but he whispers this in my ear all the time. He's like, David, don't forget the balance sheet. Don't forget the balance sheet. And he was a really good balance sheet architect. The balance sheet is the amplification mechanism. So the P&L, you got to run that. You got to get cash flow positive. If you do, then that bleeds over into your balance sheet. And then the question is, how can you maximize what's on your balance sheet? How much can you amplify the business activity? How much risk are you taking on? So I don't think entrepreneurs spend a lot of time on that. But if you look at, for instance, our president, Donald Trump, how did he get to be rich? It was all balance sheet. He borrowed a bunch of money, right? And when it didn't work out, he would just default,
Right.
which people tend to do. So I think the P&L, you got to get that dialed in because that's the business of the business. Then the question is what the multiplier is going to be on that business, figuring out how to use your balance sheet. And that's another area where I think people don't spend enough time. People don't spend enough time on this stuff anyway. They're out there just trying to make revenue.
Sure.
But I think the balance sheet doesn't get enough attention too.
Well, so let's talk about some pros and some cons that you see people doing with that balance sheet. So, if we've got this vehicle to amplify the business, how do people make missteps and how do people actually do good?
So I do think the use of leverage matters, but I think you have to go into it with eyes wide open that it can go wrong. I'll never forget in 2008, there was a guy, he came into the office, nice guy. I never saw him again. We had one meeting. And he said, Waddell, I've been tracking you. I like what you're doing. I'd like to give you some money. I said, okay, great. We go through sort of a thorough process. So let's just start talking.
Yeah.
So let's go through the asset side of the balance sheet. What's on it? Well, I got this house, I got this house, I got this house, I got this house, I got this house. And what's on the liability side? Well, I got this mortgage, I got this mortgage, I got this mortgage, this mortgage. And I said, you don't have any money. And he said, what are you talking about? I got all these houses, right? I mean, this was 06, 07, that sort of era. And I said, yeah, the banks own all those, right? And if the prices go down 5%, you're out of business. So we got to talk about doing balance sheet restructuring now. So that was an environment where the banks enabled bad behavior and somewhat took advantage. Now, they ultimately got burned.
Right.
But that guy didn't even really know. He felt like he had a lot of stuff.
Right.
But he never really did the math to know whose stuff it was. It was really the banks. And so we went through a balance sheet restructuring, and he said, thank you. There were tears shed, and then he sort of moved on. I hope he's okay today.
I was going to say, I hope he sold those immediately after that conversation before 08.
Yeah, I do too, and he may have,
Right.
So it's a question of when to put leverage on and when to take leverage off. I don't have a reason to do this right now, but basically we're coming out of recession, put the leverage on. What are you going to do? Go big right now, right? So if you can borrow money and you have a big idea, now's the time to strike, because you're going to get the tailwinds coming out of this recession with all the stimulus. Good use of balance sheet. At the end of the cycle, like unfortunately that guy did, it's a bad time to strike, right? That's a bad time to lever up. So thinking about when to flex the balance sheet, that should map to opportunities in your business at a micro level, but also to what's going on in the macro level. So
right.
If we're in the beginning of a recession, then you got to get that balance sheet small. If you're coming out of the recession, then lever up as much as you can and take advantage of the competitors in distress, et cetera. So that's what I mean about sort of tweaking it and knowing when to scale and when to pull back. Because leverage is great when it works, but when it doesn't, it's existential.
Right. And so is really from a macro level, is the recession period, is that really the only kind of moment in time that you're looking at, or are there other circumstances that you're looking at as well to say, okay, hey, now is a good time to lever up?
Well, that depends upon the business. Like, should I lever up to buy this competitor? If I do, so that's a whole bunch of strategic planning. So at a micro level, the strategic planning sort of informs that, I think, within a business. But I would just say cyclically, so, stock portfolios, you can put leverage on a stock portfolio. It was great to put leverage on a stock portfolio back in mid-March, and not so great to put leverage on a stock portfolio in the end of 1999. So there's sort of a macro when to lever, when to delever, and then there's a micro when to lever and delever. I just want everybody, if you're a business owner, depending on what industry you're in, or maybe not, this is a great opportunity to take advantage of this distress. And so this is when you want to play offense. Most people intuitively want to play offense when things are great. That's the wrong time to play offense. That's when you play defense, right? So being counter-cyclical with a balance sheet is not a bad practice.
Okay. Well, let's completely shift gears and let's talk crypto. So love to hear your insights on it. It's obviously something that buzzed, definitely a couple of years ago, big swoon, but a lot of companies are getting involved in it.
Yeah, and I think, crypto is an interesting space. Blockchain was real hot. Nobody could figure out how to monetize it. But at the end of the day, gold, crypto, even the Swiss franc are bets against the US dollar, right? So if you have a view that the dollar is going to decrease in value over time, which, by the way, it has. We came off the dollar standard in 71, 72, and the dollar's been cyclical, and the cycles are long. But if you just look at the endpoints, it's depreciated, right? Now, is that my forecast for forever? Maybe, maybe not. That's a whole different podcast. But if you have a view that the dollar is going to go lower, then buy gold. If you have a view that the dollar is going to go lower, maybe buy Bitcoin. The other complications with Bitcoin is they don't make more gold. I mean, they can mine it, but it's hard to get. And the theory with Bitcoin was that there'd be scarcity there because it's like gold, and over time, the more you mine it, the harder it is to find it. Except it's really easy to start other cryptocurrencies. So now there was, this whole suite of cryptocurrencies. Well, that's just like issuing more Bitcoins. Okay. So the crypto space got bigger. It's still primarily used for speculation and, laundering, getting money out of currencies you don't want to be in, like the Chinese yuan, and into currencies you do want to be in, like the US dollar. And is there a halfway house that maybe the regulators can't check on? And
Sure.
perhaps that's Bitcoin. So the regulators are sort of right about that. If you tied Bitcoin or a cryptocurrency to an actual hard basket of currencies, then you've really got something. That's a legit currency. That's no longer a speculative asset. That's a legit currency. So when Facebook talked about using a basket of currencies to be the collateral beneath their crypto, that was a threat to the dollar. Now, you and I talked briefly about it. I don't know whether the regulators got spooked by that, but I hadn't heard anything about Facebook's currency in quite a while. So the Fed could issue a crypto. The IMF, the International Monetary Fund, could issue a crypto. Seems to me like that happens sometimes out of the future. Will that change the nature of Bitcoin? Maybe, I don't know. But for now, it ends up being speculative, but not a bad, option if your bet's, short the US dollar. But there are other ones like gold and silver, which I think gold's up 30% this year.
Right.
So there are ways to play the anti-dollar. Bitcoin's a little bit more of a risky way to play the anti-dollar.
Okay. Was there anything else that we haven't talked about that you think is important right now?
I don't think so. I just, I want people to be optimistic. The consumer confidence survey came out yesterday and people are not. They're really just not. And I get that. I mean, we're browbeaten all day with the media, which, right, left has an agenda.
Yep.
We as individuals sort of stew on fear and view optimism with skepticism. I don't think this is a time to view optimism with skepticism. All the analysis that I've done says that, we will gather ourselves and perform economically left to our own devices. And all this government support is just going to amplify that. So I think the recession is over. There are 170 people trying to make vaccines. I think a vaccine will arrive. By the way, there was a vaccine for the Asian flu in '57. It was only 60% effective. And the economy went from being down 10% to up 9% consistently for a great period of time. So even if it's not the perfect vaccine, it might be enough to lift the restrictions and amplify the animal spirit. So I'm very optimistic about where things are. And I think I wish I could see those consumer confidence numbers higher. I don't know if you can broadcast this to 330 million Americans. I wish you would.
I'll do what I can.
Because we're going to get through this. And for those that are in distress, that too will pass. The ones that I know that have been sort of legislated out of business are dramatic entrepreneurs that can pivot. The lights will come back on and they'll be even more successful coming out the other side. So I'm a little bit of a raging bull's kind of a gross, but I'm an optimist right now in a sea of pessimists.
Okay. Well, I think that's a great place to land. And I want to thank you for coming on today. And I actually look forward to having you back next year. We can maybe do some playbacks and see what we
judge my forecast. I know I shouldn't have taken a victory lap on that March 20th call.
Well, we'll see. Either way, it'll be a good time to have you back on and just kind of get a current set of the tide. So.
Well, I appreciate you taking an interest, and I think what you're doing is great. We need more of these conversations out there, and I appreciate the conversational format of it, since you didn't give me any other questions to prepare ahead of time. And normally I would have had a PowerPoint deck, and I would have had, so.
Got to keep you on your toes.
It was great format.
Thank you, David.
All right, my friend.